Okay, good evening. This is Professor Mayer, and this is I believe it's our third chat session. If that's not exactly correct, someone can correct me on that, but we are now going to actually start talking about auditing from the perspective that I believe that we're going to be able to put some pieces together. Okay? Now, one of the things that was kind of interesting as we were going through these first couple of chapters is that we were setting the framework related to auditing from the perspective of understanding the ethics and the control environment and those types of things, but we really didn't actually talk about the audit. Okay? So what we're starting with in Chapter 5, and I think this is a very good piece that becomes very important, is we are beginning to start talking about what an external audit is all about. Okay, so let's just sort of set the framework here. So when we're talking about the external audit, we're talking about the audit where we are providing an opinion of the fair presentation of the financial statements. So our opinion is based upon reasonable assurances as to whether or not the financial statements are free of material misstatement. It's very good that we talk about the control environment, and certainly when we start talking about the control environment from the perspective of understanding the fact that we also do this audit of internal controls over financial reporting, which is part of the integrated audit, we really haven't really talked about the audit of the financial statements. So once we're now in Chapter 5, we're going to start putting the pieces together and begin to understand what it is that we do in relationship to the financial statements. Okay? Now, a couple of things to just sort of step back and keep in mind is what you noticed is I have been posting these lectures on YouTube. They're YouTube videos, and to the extent possible, actually I do a number of online classes and have a number of lectures related to auditing. So to the extent possible where that there is a crossover related to the financial statement audit and the material that we're covering, I certainly will give you this information. The other thing is it's my understanding that at this time that everybody is actually on board in relationship to the Roger CPA. Okay, so if you're not, certainly reach out to me. I know there were a couple of students that had a couple of problems, which is to be expected, but it's my understanding that these problems have actually been resolved. Now, there's going to be two components of this that that we'll talk about, and actually just sort of keep close eye on the announcements. Is what I'm looking for you to do is a specific number, and I don't have this right in front of me, but a specific number of exams, and I'll provide the guidance for this as we're going forward, but a couple of exams, and is all I want you to do in the assignment Dropbox is simply do a print screen of your results, and as long as you have greater than 75%, you're going to get these points. Okay? And the reason I'm doing this is twofold, is one of which I believe that this truly does add to the value of this class in terms of understanding audit in regards to what's required of the CPA. Okay, so that's one piece of it. The other piece of it is the idea with the Roger CPA is that it would be great, and in fact I've seen students do this, is that by going through the CPA material is that they're actually able to, by the end of this course, is take the CPA exam. And this happens a number of times that I've seen with some students. Sometimes the timing's not quite right, but that's okay. As long as you get the idea of what's required from the CPA perspective, I think you're going to be doing very well. Okay, so let's talk about the course, and we're going to focus on Chapter 5. We're going to focus on Chapter 6. We only have an hour. Actually, at this point, we only have 45 minutes. We have a lot of material to cover, and a lot of very important material to cover. And like I said, to the extent possible, I will be adding some supplementary videos that you can actually review. Okay, so what we're talking about here is the audit evidence. But the first piece that we really need to understand is this concept related to audit risk. Now, audit risk is and we need to think about risk from a lot of different perspectives. So when you think about risk, we think about the potential for something that goes wrong. Okay, now audit risk is a unique form of risk in the sense that it's risk from the perspective of the auditor. So the bottom line is that the auditor wants to issue an opinion that is in fact appropriate. So he or she wants to issue an unqualified opinion when in fact there are no material misstatements. And if in fact there are material misstatements, the auditor wants to be able to identify these issues so that he or she can then have these corrected, or if they're not corrected, be able to issue a qualified opinion. Okay? So the audit risk is the risk that the auditor is unknowingly failing to modify their opinion when in fact they're materially misstated. So the easy answer to audit risk is the risk that the auditor is wrong. Okay, now here's kind of the dilemma, and this actually is kind of interesting, is the auditor doesn't want to be wrong, but at the same time the auditor wants to complete the audit on a timely basis. So the auditor is not able to review every transaction, is not able to do a level of detail that will eliminate audit risk altogether. So what we need to do is to understand risk, audit risk specifically, from the perspective of how the auditor actually manages the audit. The next question is, what do we audit when it comes to the financial statements? Well, you notice the term here, and I want to highlight this, is the term is assertions. Okay, that's not actually highlighting, that's actually covering over. But you notice that these are assertions. Now, let's just make sure that we understand what we talk about assertions. We've already determined that the management is responsible for the financial statements. So management is responsible for the financial statements. Embedded in these financial statements are assertions related to transactions, events, account balances, and disclosures that are implied or explicit assertions of management. So as an example, if management presents on their financial statement that sales is $1 million, they are asserting that $1 million in sales transactions actually occurred, and that these sales transactions occurred during this specific period. Well, we'll talk about other assertions, but I think the idea that I'm trying to get across is when we start looking at assertions, we're looking at these things that management is embedding as decisions, as assertions related to these numbers that they are essentially saying these are the things that we are asserting related to these financial statements. Okay, and okay, so let's talk about these assertions. So, and actually I want to go back over here and I want to point something out. And this is very important, very, very important for you to understand, is that what we have is we have assertions related to account balances. So when you think about account balances, we are thinking about accounts. We're thinking primarily the balance sheet accounts. We also have assertions about classes of transactions. So a sales transaction is a class of transactions. events is things like expenses. All these things are transactions, okay? And then finally, we have assertions about presentation and disclosure, and these are related to the disclosures within the financial statements, okay? So these are the components related to the assertions of the financial statements. As we look here, what you see is these are financial statement assertions, and we have these assertions related to accounts. And again, when we talk about accounts, we're talking about account balances, again, balance sheets. We have assertions about transactions. Think about the income statement. And then finally, the disclosures. Think about the disclosures within the financial statement. Okay, so when we talk about accounts, think about this, and I want to focus on two items that are actually complementary: existence and completeness. So in regards to the accounts, and let's give an example related to fixed assets, okay? So there's a list of fixed assets. These fixed assets are embedded in the financial statements, and these fixed assets are reported as cost minus accumulated depreciation, okay? So when you see those fixed assets on the financial statement, management is asserting that these fixed assets actually exist, okay? That you can physically, and this is an audit test that an auditor would do, is physically test to see that if a fixed asset is on the financial statements, that fixed asset actually exists, okay? On the flip side, what we have is completeness. So when we look at completeness, what we're saying is not only does the fixed asset exist, but the listing of fixed assets actually is complete. So the idea is that you would not be able to go around the factory or the business and touch an asset and say, show me where this asset is on the financial statements. If, in fact, the financial statement listing is complete, that asset would be there. Okay, so existence and completeness becomes very important. Let's actually relate that to transactions. And again, we're talking about assertions related to transactions. Okay, so we're talking something very similar, is occurrence and completeness. So let's talk about sales transactions. Is if we reported that $1 million in sales actually transpired, management is saying that these transactions actually occurred. These were legitimate transactions. On the flip side is we're also saying that that list of $1 million of sales transaction is complete. In other words, there were no sales transactions that should have been reported but were not. Okay, so you notice how occurrence and completeness complement each other from a transactional perspective, and from an account perspective, existence and completeness also complement each other. When you look at rights and obligations, we think about assets. It's very possible that some of these assets may exist, but we in fact don't have rights to these. So it's very possible, as an example, that accounts receivables may be factored. When we talk about factoring accounts receivable, we're essentially saying that these accounts receivables were sold. So the fact is that they exist, but we don't have rights to those because we've actually turned over those rights to whoever we've sold those to. Okay? You also notice that, as an example, that transactions and accounts don't necessarily have the exact same assertions. So as an example, rights and obligations is an account assertion, but not in the transaction. Cutoff, when we talk about cutoff, we're talking about transactions, and we're talking about transactions that occurred in the period in which they're reported, as well as classification. Okay, so classification and cutoff, not an account balance issue, but a transactional perspective. Rights and obligations is an account, but not transactions. Disclosures is, we're primarily looking at occurrence, making sure that we're disclosing things that we have the rights and obligations to, make sure that they're complete, make sure that they're accurate, and make sure that they're understandable. Existence of recurrence, we've talked about this, is assets, liabilities, equity, interest, rights and obligation. The assets, we hold rights to these. Liabilities are true obligations of the organization. Completeness is that all assets and liabilities that should have been reported have actually been reported. Cutoff, they are reported in the right period. Valuation, think about valuation from accounts receivable perspective. When you think about accounts receivable perspective, you clearly are looking at the valuation adjustment that we make in regards to the allowance for doubtful account. Presentation and disclosure, I think that's pretty self-explanatory. Okay, now, very, very important. This is a model that, and I will tell you that I don't necessarily look at this model from a perspective of numbers, okay? But what I'm looking for is I'm looking for the relationship, okay? So if you think about the relationship is, and if you kind of view this inherent risk times control risk times detection risk equals audit risk. Now, we actually want the audit risk to be low, okay? So if we want the audit risk to be low, and we are multiplying three numbers, let's say these numbers are decimals, the point that we want to keep in mind is that if one of these numbers are high, then we need to mitigate this by lowering the other number. Okay, so the first two items is inherent risk and control risk. The inherent risk is the risk that is risk of material misstatement occurring in an assertion assuming no related internal controls. Okay? So the idea is that if there are inherent risks, and we think about inherent risks of the nature of the risk. So as an example, if we are we're a retail store that sells diamonds, we have very specific risks associated with inventory control. So inherently, there are things associated with the inventory that's risky. We have a business that we use and we have a lot of cash handling. Cash is risky. So inherently, cash is risky. So the issue becomes is how does management control these risks? And this is what we're talking about is the control risk. So the control risk is that a material misstatement and an assertion will not be prevented or detected on a timely basis by the company's internal controls. Well, we've established the fact that management not only is responsible for the financial statements, but management is also responsible for the internal control structure within the organization. So for every inherent risk, management needs to control this risk with internal controls. The control risk is lowered by increasing the level of control. Okay? So when you think about, and again, we're multiplying the two numbers, inherent risk and control risk. When you think about these two elements of inherent risk and control risk, what we're really talking about is the risk of material misstatement. We're not saying that there is a material misstatement, but what we're saying is that the risk is there. So in other words, the inherent risk we're saying is high because there is something about the transaction or the account balance that's risky. Okay? Control risk is also high because management hasn't developed an appropriate level of internal controls. So inherent risk times control risk is the risk of material misstatement, and if the controls aren't there, the risk is going to be high, the risk of material misstatement. Now you notice that the last item is detection risk. Well, detection risk is where we are looking at the auditor's procedures. And what we mean by this is that the auditor is responsible for managing detection risk. So the audit procedures, and we call these substantive testing, is where we are measuring monetary misstatement. Okay? So detection risk is the audit procedures where we measure monetary misstatement. The risk of material misstatement is the risk. It doesn't mean it's happened. It just means that there is the risk that this may in fact take place. So what we have is we have the detection risk where and we're going to talk about this from the perspective of the nature of testing, the timing of testing, and the extent of testing, that the greater the risk of material misstatement is we need to mitigate this risk by lowering the detection risk. So we lower the detection risk, as an example, by doing more testing, or we lower the detection risk by timing our testing nearer year end as compared to maybe interim testing. Okay, so the auditor is responsible for managing the detection risk, and the auditor is able to do this based upon his or her assessment of the internal of the risk of material misstatement. Okay, so again, this is exactly what we're talking about, is audit risk equals inherent risk times control risk times detection risk. Okay, so these are the three elements, and again, what we're looking for is we're looking for the audit risk to be low. And again, if the control risk is high, and if the control risk is high, this essentially means that management does not have a control structure in place. Is to mitigate this is we would have to lower the detection risk by doing additional testing, and doing testing that would be maybe a different type of test as compared to the type of testing that we would do if there's a low risk of misstatement. Okay, but again, the idea is that when we look at audit risk, and the auditor will always have a level of risk that he or she is willing to accept. And the reason he or she is willing to accept this is because, again, at the end of the day, the auditor is only saying that we are providing reasonable assurances whether or not the financial statements are free of material misstatement. So we're not doing absolute, only reasonable. So within reasonable assurance is the reality is that there will always be some audit risk. And again, why do we not go the whole way and lower audit risk to zero? And the reality is that we don't do this because audit risk is something that we need to manage, and we need to manage this from the perspective that we need to get the audit done, we need to get it done in time, and we need to process these transactions in such a way that the financial statements and the audit report can get out on a timely basis. So let's talk a little bit in more detail related to these areas. The first area is inherent risk. So again, when we talk about inherent risk, is what we're talking about is the nature of the client and its environment, the nature of the financial statement element, and then we'll talk about the indicators of high inherent risk. But as we go through the audit, the first thing that we need to understand is that we conduct a risk assessment to understand the nature of the client and its environment. Okay? We need to understand the particulars related to the financial statement elements and determine if in fact there is a high risk associated with these issues. Okay? Now, some issues that we want to consider in regards to high risk, and again, that's what we are looking at, high inherent risk, is inconsistent going concern issues. We haven't really talked about those, but going concern issues are these things that if an auditor were to look at the financial statements, the auditor would say there's a probability that this company is not going to survive. And then if there were known or likely misstatements detected in prior audits, this by definition is going to increase our inherent risk from an employee perspective, substantial turnover, questionable reputation, inadequate accounting skills of management. These are the kinds of things that are actually going to impact the inherent risk related to the financial statements. Assertions with high inherent risk. These involve transactions that are difficult to audit, complex calculations, difficult accounting issues, significant judgment by management, valuation issues that vary significantly based on economic factors. So some of the things that we would be interested in is understanding related party issues, understanding complex calculations. Maybe we're using the percent of completion, and as we know, percent of completion is problematic because it's very difficult to come up with a very specific percent of completion related to a project at year end. That's just an example. Difficult accounting issues, maybe we have off-balance sheet transactions. Again, related parties is an example of difficult accounting transactions. Significant judgments by management. Well, we're always going to have judgments by management. This management's responsible for the financial statements. They always are going to be making assessments related to estimates within the financial statement. These estimates are going to vary based upon the industry and otherwise. Transactions, when we think about transactions and inherent risk, routine transactions, we have a low inherent risk. Non-routine transactions, we have a high inherent risk. Estimation, anytime we estimate, so again, things like the allowance for doubtful account, this is an example where we are making an estimate. This absolutely increases the inherent risk. So what we're looking for in terms of audit evidence, and I want to just sort of point out a couple of things here. When we talk about audit evidence, one of the things that we need to understand is that we are never going to be convinced. Okay? So convincing the auditor is not appropriate. What the auditor wants to be is persuaded that the financial statement or this account is appropriate. Okay? So how do we do this? Well, we do this by looking at evidence. And we'll talk about what evidence is in a little bit, but evidence essentially is everything that we look at. Transactions, observations, everything is evidence. So what we're looking for is sufficient and appropriate. So sufficient defines the amount of evidence. Appropriate relates the evidence that we're looking at to the specific assertion that we are attempting to test. Okay? To be appropriate, the audit evidence must be relevant, so it must be relevant to the assertion, and it must be reliable. Okay? And again, it's not going to ever be perfectly reliable, and this is where there's a lot of critical issues that the auditor needs to consider as he or she is investigating this evidence. Okay? But these are the issues that we need to consider. Audit evidence is ordinarily more reliable when it is from a knowledgeable, independent source. So we're talking about knowledgeable, independent sources. When it is outside the company rather than non-dependent sources. When it's generated internally through an effective internal control system. When it's obtained directly by the auditor rather than indirectly or by inference. So as an example, when we confirm accounts receivable or account balances from banks, we actually have that documentation sent directly to the auditor as opposed to having the auditor go to the organization and ask for this. Documentary evidence in form rather than oral. So we talk to the CFO and he explains, or he or she explains, why they did the estimate related to allowance for doubtful account. That's one thing. But if they actually documented the decision process at the time, signed off by the CFO and the controller, that would be a much higher level of control. Original documentation rather than copies. Now, I will tell you this certainly poses a problem in our world of electronic documentation. We don't actually get bank statements, as an example, anymore. Okay, we get bank statements, but they are going to be electronic bank statements. So the issue becomes is, well, you ask for the bank statements, what is the CFO going to do, or the controller, or he or she is going to print these. So the issue becomes is, this is an example of understanding that the technology is such that it really does complicate things in relationship to getting the correct documentation. Category of audit procedures, let's go through these. And I'm going to put all of these things in context here. Okay, so there are 3 stages of the audit. And I will tell you that when you talk about the stages of the audit, we also need to keep in mind that the stages of the audit are such that we think about it conceptually as sort of crossing a line going from the risk assessment to testing of controls or substantive testing. But the reality is that in the true audit, when we operationalize the audit, there really is a crossover in terms of how we're actually doing this stuff. So we're sort of kind of doing this all together, but we need to kind of conceptualize it from the perspective of what we're talking about here. Okay, so risk assessment, again, what we're attempting to do is to understand the risks associated with the organization. So we're looking for the risks associated with the inherent risk related to accounts. We want to understand the environment. We want to understand the business model. When we talk about risk assessment procedures, we're also doing things such as analytical procedures, in other words, ratio analysis, to see how things have changed from one year to the next. Okay, so risk assessment procedures is really intended for us to understand inherent risks associated with the organization. We then start doing our test of controls, and we talk about further audit procedures. And again, keep in mind that in the integrated audit, where we're looking at internal controls over financial reporting as part of the overall audit, as our test of controls becomes very important. But in any event, the test of controls from a financial statement perspective, in association with the risk assessment procedures, is going to give us a measurement or an understanding of the risk of material misstatement. Now, one thing I do want to point out here, and I think this is very important, is that when we talk about test of controls, we are looking at transactions. We're looking at events and transactions. So we think about test of controls. We want to think about transactions. So as an example, the sales transaction. And we'll get into this when we talk about specific business processes. But again, think about test of controls where we're looking at transactions. Now, we finally do our substantive procedures. So again, think about the audit risk memo. First thing, inherent risk, which is part of our risk assessment procedure. Next, we do test of controls, which combined with the risk assessment determines the risk of material misstatement. Once we've determined the risk of material misstatement, then we can determine the nature, timing, and extent of our substantive procedures. Substantive procedures, very important. Substantive procedures is where we measure monetary misstatement. So we are doing these procedures to detect material misstatements at a relevant assertion level. Substantive procedures include analytical procedures, we'll talk about these, test of details of account balances, transactions, and disclosures. So you notice when we talk about substantive procedures related to transactions is we are measuring monetary misstatement. So just kind of think about this is, as an example, the sales transactions is, on a sales transaction, is we are looking at it from a control perspective. What are the controls embedded in the sales transaction? So that's our test of control. But we're also looking at transactions for sales in terms of determining whether or not there are material misstatements in the sales balance for the year. Okay, so we need to think about our balances not only from our balance sheet perspective, but also the balances in regards to these sales and expense transaction accounts that ultimately are going to flow into our retained earnings. Let me just go back here, and I do want to make a point, and I know this is made several times within the book, is you notice that we're talking about analytical procedures as substantive procedures. Analytical procedures are, again, ratio analyses or anything where we're using numbers. Okay? Now, in the ratio analysis, this becomes very important and is a required procedure in our risk assessment process. So in the risk assessment process is we are looking at various ratios, days sales outstanding, gross profit margin, sales increase from last year, various procedures, and some of them are going to be unique to the industry. But these are risk assessment procedures that are absolutely required to do. But we are using those procedures at the risk assessment level to measure our risk of material misstatement. In our substantive procedures, we are looking for monetary misstatement. Analytical procedures, a classic example of an analytical procedure as a substantive test is using analytical procedures to validate the allowance for doubtful account. In this case, what we would look at is we look at the aged trial balance related to our customers and make some estimates related to the longer the account is out, the less probability we're going to have to get paid. So I'm sure you've looked at the allowance for doubtful account from the perspective of the aged balance of accounts receivable. That would be an example of an analytical procedure for as a substantive procedure. Types of audit procedures: inspection, inquiry. Actually, if you look at these two items here, inquiry and observation. Inquiry and observation is a key component of our risk assessment and our testing of internal controls. We need to understand what the internal controls are. We understand this by asking questions, and we observe these internal controls that are in place. Okay? And someone came in, and I'll just mute you here. Okay, there. Okay, excellent. Okay. Recalculations, reperformance, we talked about analytical procedures. Continuing on here. And actually, I think I'm going to, I want to get a look, actually, we need to get into Chapter 6 for a few minutes at least. But I think what we've done is we've covered the substance of Chapter 5. I'll do make a couple of points related to our substantive testing. Substantive testing we've talked about includes our analytical procedures. We are doing test of details, account balances, classes, disclosures, and we're using this framework here the nature of the testing, the timing of the testing, when it's performed, and the extent or the quantity of testing. These become the elements as it pertains to substantive procedures. And again, why are we doing substantive procedures? We are doing substantive procedures because we are measuring monetary misstatement. Okay, let me now go to Chapter 6, and at least I want to cover some key components related to this. Okay, so this is going to be Chapter 6. Okay, Chapter 6. Okay. So for the next 15 minutes or so, a little bit less, is we're going to talk about some audit planning and risk assessment procedures and responding to these. And we're looking at this from the perspective of engaging a new client or actually working with a client that we've actually worked with in the past. So obtaining new clients is certainly the first thing we want to do is we want to contact the audit committee, make the arrangements. Now, notice this, very important, is communicating with the predecessor auditor. Okay, so the point that we want to make here is that as part of the audit of obtaining a new client is we need to understand the client. We need to only be working with quality clients, clients that have a high ethical value. And how do we find this out? Well, one of the key ways that we're able to do this is by communicating with the predecessor auditor. Okay, so we can't, because of confidentiality, go to the predecessor auditor and start asking questions without permission from the client. So part of our process, part of our due diligence, is to ask the client for permission to talk to the predecessor auditor. Now, if the client says, no, I don't want you to do this, this would not necessarily prevent you from bringing on this client. However, it would absolutely raise a red flag that there may in fact be an issue. Okay? I mean, clearly there's going to be situations where the client's going to explain why he or she doesn't want you to talk to the predecessor auditor, and these may be legitimate reasons. So we're not saying you can't talk to the predecessor auditor, or that by not talking to the predecessor auditor, this is going to prohibit you, but it's certainly something to consider. Because what are the things that we're interested in talking to the predecessor auditor about? Well, you notice a couple of things. The integrity of management, any disagreements over accounting principles, communication to those in charge with governance related to fraud and non-compliance, any communications that the predecessor had to management, and related to internal controls, internal control weaknesses. We want to find out from the predecessor's position why the client is interested in changing auditors. And it may be as simple as they're looking for a cheaper audit. And there's nothing wrong with negotiating price, absolutely nothing. But we're ultimately looking for an overall evaluation of management's integrity. The audit steps. So let's talk about this. After obtaining the client, the process would be to plan the audit, to obtain a understanding of the client and its environment, including internal controls. So when you look at number 2, we're talking about that risk of material misstatement. And that's what we have in number 3, assessing the risk of material misstatement and designing further audit procedures. Well, how do we assess the risk of material misstatement? By understanding the client and its environment. So we're doing this risk assessment, so we're understanding where the risks are, and then we are doing these tests of internal controls, so we're understanding what the control risk is from the perspective of, does management have effective internal controls to mitigate these inherent risk issues. And then we perform further audit procedures. And again, from an integrated audit perspective, as we're doing further testing related to internal controls, where we are providing an opinion of the internal, and we're also looking at it from the perspective of our substantive procedures, where we are attempting to measure monetary misstatement. And again, from the financial statement perspective, measuring monetary misstatement is the purpose of our substantive testing, and this measurement becomes the basis for our opinion. Okay? We complete the audit, we form an opinion, and these are the basic issues that we are working through. So we establish an understanding with the client as to the nature of the engagement. We develop the audit, we develop a strategy, a plan, and a program. So the audit strategy essentially is high level. The program is the detail of what testing that we're actually going to do. We obtain an understanding of the client and its environment. This is where we are doing our testing. You notice here we're doing analytical procedures. We are doing observations and inspections. We are making inquiries outside the company, legal counsel, valuation experts, and so forth, and reviewing this information. And again, understanding the client, its environment, and internal controls is we are actually testing these internal controls. Now keep in mind that the test of internal controls primarily is focusing on these observation and inquiry of management related to the internal control process. We then assess the risk of material misstatement, and what we're looking at is what can go wrong, the magnitude related to what might go wrong, the likelihood of material misstatement, and from here we are designing further audit procedures. So these further audit procedures includes analytical procedures, procedures also related to tested controls, as well as our substantive procedures. Completing the audit, we'll talk about some very specific things as we go through this book, but we're going to be searching for unreported liabilities, reviewing the minutes of the minutes to the board of directors meetings, performing a review for subsequent events, and obtaining a representation letter. So we're going to be talking about the details of this as we go along, and then based upon this we're going to form an opinion. So this table here actually defines the audit process. And we've talked about a couple of things in Chapter 5. We've sort of framed this from the earlier chapters, but over the next couple of chat sessions, we're going to get into much more detail specifically related to this audit process. Okay, so planning the audit, we establish an understanding with the client. This ordinarily is accomplished through an engagement letter. Okay, so in your chapter, there's an example of an engagement letter. I'll make sure that this is posted in the material that you see. Related to this is we need to determine our independence requirements. So we would not have accepted the client if the firm itself was not independent. However, when we start developing the team, we would make sure that individuals that are working on the audit have no independence issues. There's no issues related to management integrity, and the client actually understands the engagement. So the engagement letter identifies obviously the name of the entity, management's responsibility, the auditor's responsibility, arrangements for conducting the audit, the use of specialists or internal controls. It's very possible, and we'll actually talk about this, that we will be using the internal audit staff as part of the process. Nothing wrong with that. In fact, sometimes the engagement letter will define how many hours of the internal audit we're actually going to use. Obtaining information from the predecessor auditor. very important. This is different from our inquiries of the predecessor auditor. Now what we're looking at is we're interested in reviewing the documentation of the predecessor auditor, which becomes critical for validating beginning balances related to asset accounts, investments, and so forth. So it's absolutely critical that we have this so that we can conduct the audit appropriately. We would also be interested in if there are actually changes in accounting principles. And the only way we know that is if we're able to work with the predecessor auditor and review their work papers and ask some very specific questions related to the audit. And again, this information that we're doing here is very different from our original inquiry where we're looking at the ethics of management. The engagement letter would also define fee and billing, and possibly other services, limitations of the audit, and conditions under which access to the auditor's working paper may be granted to others. Audit planning overall, we have, again, strategy is the overall framework of the audit. The use of the client staff, again, we want to make sure we have the right team in place. We need to understand if we're going to use other CPAs or arrange for specialists. So specialists may be there for evaluation. They may be there, as an example, related to IT issues. Depending upon the organization, maybe we're going to have specialists related to their defined benefit or their investments. However the case may be, these are the things that we're looking at. Well, we've talked about the communicating with the predecessor auditor to establish opening balances for the financial statement, obtaining an understanding of the risks associated with the organization. I think we've talked about this in a lot in detail. Understand the client, and again, we're doing this to understand the risks associated with the client, accounting policies and procedures, ownership, capital structure, products, and so forth. Internal controls, these are, and then the industry and other factors. Clearly we need to understand what the regulatory environment is that they're working with, major laws and regulations, economic conditions, attractiveness of the industry, barriers, strength of competitors. We're really looking at this to understand the risks associated with the organization, because if there's risks, we need to understand what management is doing in terms of mitigating these risks with specific internal controls. So once we have the strategy, we then look for the overall plan related to the audit. We do this based upon our business risks, and we're looking at budgets, key performance indicators, variance analysis. When we talk about variance analysis, we are talking about things such as the analytical procedures that we've talked about before. Okay, let me actually see if there's one or two slides that I want to make sure that we've covered here. I think we've trail, audit documentation, I think we've done that, transaction. Okay, I'll just close with this, is we've talked about the audit from the perspective of management assertions. Okay, so these are the things that we're going to be testing, and we'll give you some very specific examples of that. But the way we audit is based upon transaction cycles. So we'll look at revenue cycle, the purchasing cycle, payroll, investing, financing. We'll talk specifically about each of these. But it's very important for us to understand that as we are auditing, we're looking at the audit from two prisms, one of which is management assertions, but also, and as important, is understanding it from these cycles. So the revenue cycle, or the revenue process, becomes the basis for the audits. Okay, I think we've covered all the material that I want to cover. I'll actually post a couple of announcements to make sure that we're all on track. And I think we are actually pretty good to go in regards to most of the variables. the Rogers CPA appears to be up and running for everybody. The exams, I think, are coming along nicely. If you have any specific issues, email me, and I'll try to address these. But other than that, I think we are good to go. So I thank you very much for your time and attention, and we will talk again in a couple of weeks. Okay? Okay, thanks a lot. Okay, bye-bye.